Good morning, everyone. Welcome back to Morning Kappa at 8. Aiman here. Right, so if you look at the S&P 500, well, it closed higher on Wednesday's session, again gaining around 1%, hitting a fresh record high above 7,100 level. So overall sentiment was strong with continued buying interest across the market. So yeah, the rally was mainly driven by a strong corporate earnings in coming in better than expected, which boosted the confidence in the market as a whole, right? So sentiment was also supported by optimism that tension could stabilize following the development around the, ceasefire extension, which helped to improve the overall appetite. However, I think despite the strong move recently. I think some caution remains as the oil price has still elevated and risks have not fully disappeared, right? So looking ahead, I think the market is expected to maintain a slight upside bias, but some volatility towards the near high. Looking at our US trading stocks, so we have published CrowdStrike, stock code CRWD. So the stock's experiencing a pending breakout at $450 level, and now we can expect the stock to travel towards the $500 level resistance on a strong momentum, followed by the next resistance is at $540 level. Now, if the counter reverse, do watch out for the $420 dollar level for the immediate support. And next we have Salesforce, stock code CRM, right? So look at charts now. The counter charted higher high, um, testing this $193 dollar level. So if the stock to climb up higher, we could see that it might travel towards $205 level. Uh, the second resistance is at $220 level. So now if the stock slides lower below this $176 level, so this might shift to a bearish structure. Yeah, so we have two pending stocks for the US market for today, right? And looking at the China A50 futures, well, it closed slightly higher yesterday, holding above this 15,500 points level, which I think this shows some near-term strength to the market. So overall sentiment is improving, but still cautious underneath. I think yeah, the upside was supported by better sentiment across the regional peers market, but at the same time, the China markets are also seeing support from the stronger recent economic data as well as the uh, policy stability, right? Yeah, however, I think despite the recent strength, investors remain cautious on the broader economic outlook as well, which is why the upside is still gradual rather than aggressive. So moving forward, I think this China A50 futures is expected to remain firm above 15,500 level and do not discount for any near-term pullback. But at this juncture, the bullish trend or the bullish momentum still remains intact, right? As for the WTI futures, crude oil futures, well, it closed higher on Wednesday session or yesterday session, extending the gains after the recent volatility. Yeah, sentiment remains firm, but still very much driven by the headlines, lah, right? I think the upside was mainly driven by the escalating tension, after reports of the attacks on vessel in the Hormuz Straits, which I believe that it raised concern over the global oil supply disruption as well. Also, oil prices were further supported by the sharp drawdown in the US fuel inventory, which added to the bullish sentiment and also pushed the price higher during yesterday's session. So again, however, the market volatility is still there as the there are still ongoing talk and also the uncertainty around the possible ceasefire, which is preventing prices to move in a uh, straight straight uptrend, right? So yeah, overall price action is still driven by the geopolitical risk premium as a whole. Looking at our Malaysian market, our local market, uh, the FBMK LCI closed slightly lower yesterday, pulling back by 0.29 or 0.3% to close somewhere around 1710 points, while the FKLI also is lower. Yeah, I think for our Malaysia market, overall sentiment was still cautious with buying interest fading to the close yesterday. I think the weakness was mainly due to the profit taking in the index heavyweights, especially after the recent rebound um earlier in this week, which dragged the index into negative territory yesterday. Also at the same time, um the market was also influenced by the mixed regional sentiment and also the ongoing geopolitical uncertainty, particularly around the US-Iran development, which kept investors on the sideline. So yesterday, overall, the move looks like more towards the healthy consolidation rather than a strong risk-off move for our Malaysia market. Right. So moving forward, I think the market is expected to remain in a positive uh, uh, cautious tone here. Um, yeah, so if you see here, the market was dragged by broad-based weakness in the banking heavyweight, such as the Maybank, public bank CIMB, alongside with softness in the utility led by Tenaga as well. I think while selective gains in the healthcare and also plantation counters offered some support to the market, overall sentiment remains neutral, right? As selling pressure in the key index link stock dominated the session yesterday. So I think market are now focusing at the energy sector once again after it went up by 1.7% yesterday, while the other sector remains its sideways movement up and down, yesterday. Looking at our Malaysia trading stocks, so we have Sime W Property. So the stock is on its breakout formation, higher at 1.35 level on a strong volume. With that, we expect the momentum to keep bullish and the stock able to propel to the next resistance at 1.43 cent level, followed by 1.51 level. So if the stock to clear below this 1.27 support, this could reverse the course, and this might shift the trend, and it will trend lower. Next, we have QS Group. So the stock is experiencing a breakout as well at 42 cent level. So if the stock to remain bullish, we expect the price to travel towards 45 cent level. Second resistance is at 48 cent level. So do keep an eye at this 39 cent level for any attempt of reversal. So for Malaysia trading stocks, we have two breakout stocks, which is SimeW and also QS Group. And for those of you who trade FCPO, well, it closed higher on yesterday's session, extending its rebound with strong buying interest seen during the session yesterday. So I think the overall tone is improving, right? And the upside was mainly supported by the strength in the crude oil as well as the soybean oil, which I think it has lifted the sentiment across the edible oil in the picture, right? So we are seeing some recovery buying after recent weakness right here, as price had pulled back earlier and are now stabilizing at this 21-day moving average. So, however, I think gains may be capped as the market is still facing a concern over the raising production and also softer export demand, which higher price potentially slowing the buying from major importers like India as well as China. So moving forward, I think we do see that the FCPO will travel higher in line with our positive trading bias, eyeing for 4,800 level. Second resistance is at 4,925 level, and our stop loss remains firm at 4,400 level. Right. So I'll stop here and pass the floor to John. Thanks everyone and happy trading.
Hello, morning everyone, and thank you, Aiman. So we are issuing our transport strategy today. We upgraded the sector call from neutral to overweight following the US-Iran ceasefire extension to be in line with our buy call on the sector heavyweight Westports. So the main reason for us to upgrade the sector call is because we view Westport current price level is attractive for accumulation. So first of all, we need to know why Westport share price is underperforming lately. This is actually because of two reasons. One is the rising fuel costs. Another one is investor concern on Westport not delivering a low single-digit kind of container growth as per management guidance. However, in our view, Westport fundamental remains intact and they are relatively insulated from the Middle East conflict, given their limited direct exposure and a continued reliance on intra-Asia trade flows. So now with a healthy yard density of 70 to 80%, we maintain Westport container volume growth forecast at 4.5% in 2026, within management unchanged guidance of low single digit. So talk about the rising fuel costs first. Based on our sensitivity test, every 10% increase in the fuel cost could drag their earnings by 1% lower. And not to forget that this assumption is based on the Brent crude oil stay high for the entire year. Hence, we believe the current environment presents an appropriate window for the government to establish a price mitigation mechanism to pass through the higher fuel costs. So how Westport is going to deal with this issue is that they are going to deploy 60 EV trucks in the third quarter, and we estimate the deployment of the EV trucks can save 10% of the truck diesel consumption. And on the other hand, talk about the container volume. We maintain the Westport container volume growth forecast at 4.5%, and this is in line with RHB Economics unchanged Malaysia GDP growth forecast of 4.7% in 2026. And notably, Westport container volume growth has a strong positive correlation at 0.9 with Malaysia GDP growth over the last 15 years. So RHB econs expect the growth to be supported by a resilient domestic demand and E&E exports. Not to forget that Malaysia appears the least affected among the Asian economies under the current conflict scenario. And another reason why we think Westport is insulated from the Middle East conflict is there's only 5% of the container volume is exported to the region. And the management has confirmed that all the services, all the calling from the regions are now remain active. And notably, some of the liners are diverting cargo at alternative hubs like Westport due to the limitation in Strait of Hormuz. However, the group is now strictly refusing any boxes with unclear final destination, keeping the yard density at a healthy range of 70 to 80 level to avoid congestion. Hence, we believe Westport fundamental remains intact by their strategy focus on intra-Asia trade, which is the single largest contributor at 62% of the FY25 total container volumes. Meanwhile, there are two new warehouses commencing in April and June, which will provide an additional 500,000 TEUs per annum. So for now, our top pick for the sectors are Westport and also Tasco. We continue to like Westport because its solid earnings growth trajectory is underpinned by the 30% port tariff increases. Number two, the resilient container growth volume, supported by the strong correlation with national GDP and also the stable intra-Asia trade flows. And last but not least, Westport 2 expansion is serving as a long-term catalyst to overcome their current utilization ceiling. On the other hand, logistic players will be the key beneficiaries should we see an elevated freight rate, if there's any, arising from the global route disruption. Hence, we prefer Tasco amid its 400,000 square feet warehouse expansion at Shah Alam, and also the 300,000 square feet warehouse development at Northport, commencing their operation in mid of 2026, slated for a minor contribution into second half of FY27. So long story short, the concern of a slow economic growth has led to an attractive re-entry opportunity, while the fundamental of Westport remains intact, offering a 4.6% FY26 dividend yield. And in terms of the valuation, Westport is now trading at the 3-year and also the 5-year mean PE mean of 14.6 times, which we see as an attractive price level for accumulation. This is mainly attributed to Westport has been trading at a premium to their historical PE at 1.5 standard deviation or even 2 standard deviation since government to increase 30% of the port tariff since second half of last year. And for Tasco wise, the valuation is also attractive as Tasco is now trading at a PE of 6.7 times or -1 standard deviation from their 5-year average of 10 times, when the comparable peers are trading at an average of 8 times. So we view this valuation as attractive amid the new warehouses expansion operation in mid of 2026, slated for my minor contribution into the second half of FY27. So all in, the downside risk to our call is should a prolonged or intensified escalation of the Middle East war could lift the oil prices and weigh on the growth. If the elevated oil price persists until the third quarter of this year, alongside a supply disruption, the GDP growth of 2026 may ease to around 4%. And the downside impact on Westport is a 3.6% container volume growth for this year, which translates into a TP of 6 ringgit and 79 cents, as compared to our current forecast of 6 ringgit and 89 cents. I'll stop here and pass the floor to the next speaker. Thanks.
Thank you, John. Let me continue with the company update on Guan Chong Berhad. This is following a recent meeting with the management. So basically, FY26 is shaping up to be a much better year on the back of a low Brent price environment as well as a contango market structure. Now, a bit of background on 2025. 2025 happens to be a reset year in terms of demand. This is following the sharp rise of cocoa bean price in 2024 and 2025 that reached about $12,000 per ton. Now, that has caused the global grinding demand to contract by about 4.3% year on year into 2025, as the elevated input cost has led to recipe reformulation as well as substitutions, for major chocolate makers. Now, meanwhile, on the supply side, I think the supply rebounded by about 8.4% year on year on improved yields and favorable weathers. So that has essentially swinged the market from a 400 to 500 ton of deficit in 2024 to a 75,000 ton of surplus in 2025. Now, the consensus is now pointing to a wider surplus of 150 to 200,000 tons in 2026 on the back of further supply recovery. Now, in demand side in 2026, we have seen early signs of recovery. Asia grindings numbers came out to be about 13% up Q on Q in the first quarter, whereas on the European side, we saw a 7% rebound in terms of the grinding demand into first quarter. Now, with the expectations of bean price normalizing at current 3,000 to 4,000 per ton US dollar per ton level, and butter ratios ease to about 2 times, the demand has started to see recovery. In fact, certain chocolate makers have also announced that they have committed to revert to the original recipe, which contains more cocoa ingredient coming off from the other substitute products. Now, all this demand recovery, coupled with the potential adverse weather, a high probability of El Nino phenomenon this year, may potentially point to a narrower surplus compared to the market expectation. So should that happen, this will also support a better combined ratio, which is the ASP for the cocoa ingredients. In terms of guidance, I think management highlighted that 50% of this capacity has been covered in 2026, with better ASP ahead. The plant utilizations was at about 80 to 85% in the first half of 2026, and they're guiding for above 90% in second half of 2026. In terms of interest costs, as well as gearing, we should see a much lower gearing level as well as interest costs. I think just to recall, last year they recorded about 330 plus million of interest expenses alone, and a derivative loss of 738 million in 2025. Now, the lower bean price should translate into a 40 to 50% year-on-year interest savings, provided the bean price stay at current level, versus our forecast of only 25% interest savings year-on-year. That points to a potential upside to the earnings. Besides, we are also seeing a more stable earnings trend this year with a reduced volatility in the bean price as well as a hedging loss and costs. Now, the gearing, has reached 1.35 level in the fourth quarter of 2025, coming off from the peak of 1.9, back in the second quarter or first quarter of 2025. This is as the working capital pressure is, on the back of lower bean prices as well as hedging costs. Now, in terms of the expansion, they are guiding for the second phase of Ivory Coast expansions to be ready, fully operational by third quarter of 2026, which will add about 17% additional capacity, to the company. They are also guiding a better dividend guidance this year with the improved balance sheet, with a minimum of 4.5 cents per share. That should yield about 5.4% at current price. On the back of all this development and new updates, we remain upbeat, on the stocks, as we think at the current level of 7 to 8 times PE ratio, it stays oversold, especially on the back of stabilizing operating backdrop, and a much lower, normalized bean price environment, and also a much improved balance sheet situation this year. Now, maintain bond the stocks, maintained the target price of 1 ringgit and 30 cents. And the key risk, to our call, of course, this year is on the sharp raw material price fluctuations, as well as a weakening demand and execution risks. I think that's all from us today. Thank you for listening.